All right, guys, it's obvious that institutions have radically changed crypto and the bull run, of course, with the ETFs too, but it's mainly institutional investing. But it's kind of BS because we're getting a lot of the disadvantages in crypto and not a lot of the advantages, and that's kind of the fault of the industry itself. Let's actually look at some historical prices of the year after the halving in the previous cycles. For instance, 2021, Bitcoin on January 1st was 29,374. At the end of the year, December 31st, 2021, 46,306. Even though Bitcoin had started to go down by the end of the post-halving year, it would still at least about 50% up, if not slightly more, than when the year started. Going back even further, January 1st, 2017, $998.33. At the end of 2017, December 31st, $14,156. So you look at this, obviously that's up like 14x. This is up like 50%. But this year it looks like it's going to be down because on January 1st, 2025, it was $94,419. Right now it's $95,216, but we are trending downward. And if we don't turn around by the end of the year, to match 2021, it would actually have to be at about $135,000 to actually match. And I don't think we're getting there. But if we actually go down 1K more, we'll actually end the year lower than where we started the year. And that's kind of disrupting how things actually should be. Obviously, a lot of that is because of the Trump tariffs, which he's kind of rolling back at this point. But the damage has already been done. But it also shows that's not only the tariffs, obviously, that is some of the institutional effect. Now, some of you are saying, well, they're putting money into Bitcoin. How is that hurting? It's more of their dominance and their lack of really any regulations in crypto, which allow them to take advantage of the market. So basically, since they're allowed to come in now, they're more or less able to control the market with their large amounts of money, but also they're not really bound by that many regulations or enforcement in crypto like they are in the traditional market. So the free-for-all kind of applies to institutions as well, and there's a lot of shady activity going on. We say that Binance will control the market. Well, now BlackRock can do that too, especially with all the perp trading and leverage trading that's going on, and they can trade and leverage against regular retail buyers. Binance is not the only one that can do that, and BlackRock has at least as much, if not more, financial power than Binance. Now, they still have to be a little bit more careful being a fully regulated financial institution, obviously, but in the crypto market, there isn't really people keeping track and there isn't really enforcement, and the Clarity Act really isn't going to help that. It's really not going to all of a sudden magically enforce Bitcoin regulations from BlackRock. So I do actually think there's a bit of that going on as well. So BTC is really being affected by that. I do think the big institutions are pulling the market along with Binance and everything else. So although they've taken volatility on Bitcoin down, which may actually not be a great thing for retail investors, the altcoin thing, I believe that like subtly, a lot of these big institutions are in altcoins as well, just not on the surface because they can't report it, but they're probably have some backroom dealings with it, and they are liquidating against retail investors. And of course, since a lot of people moved into perps and leverage, it's even more easier for them to manipulate it. Of course, Binance and other exchanges are doing this as well. Now, technically, I've asked how institutions have changed the crypto market. Now, it gives good answers, but it's not looking at the darker side. So institutional participation has profoundly transformed the crypto market by shifting it from retail-driven speculative environment to a more mature, stable, and regulated asset class. That's true on the surface, but I think in the altcoin market, especially with so much leverage and perps, I do think institutions are manipulating liquidations both ways as well to benefit themselves, because without real regulations and enforcement, it kind of be foolish for them not to. I mean, they're saying if Binance and other exchanges are doing it, why don't we do it? Because we have the capital as well. Maybe there's even some working together with the big exchanges to actually screw retail investors. So it says the influx of institutional capital characterized by long-term strategies and large over-the-counter trades has increased market liquidity and helped absorb price shocks, reducing the extreme volatility seen in earlier retail-dominated days. Algorithmic trading and sophisticated risk management by hedge funds further contribute to market stability. Sort of. But remember, even during the bull market, we did have like a 35-40% dump from about 109 to 75, and that's just triggered by the Trump tariffs. So you can say like institutions are preventing that, but with El Presidente coming in, and institutions can actually benefit from that as well if they have insider information, which I think a lot of them do. So I think it goes both ways. When you have the president of the United States running his own shitcoin and making these announcements that can massively crash the market, I definitely do think institutions can take advantage. And of course, without not really without regulation, but without enforcement in the crypto market, there's really nothing to stop them. Development of robust infrastructure to meet institutional demands for security and compliance. The industry has developed enterprise-grade infrastructure. This includes advanced insured custody solutions offered by firms like Fidelity Assets, Coinbase Institutional, and BNY Mellon, which provide the security and regulatory alignment necessary for a large-scale investment. But that's mainly only for Bitcoin. For the altcoins, they don't really get that. We still hear about coin hacks on exchanges all the time. That does benefit some of the institutional investors, but it does not benefit a lot of the retail investors because a lot of the exchanges don't have that, and I still think backdoors are purposely put there because really no one's enforcing these rules on crypto. So creation of regulated investment products, the approval of spot and Ethereum exchange-traded funds, or ETFs, in the U.S. has been a pivotal moment, allowing institutional investors to gain exposure to digital assets through familiar regulated investment vehicles. That's true. That's brought a little bit more money in. I also think that's gotten like a lot of the other spot investors to invest in these ETFs, which may not actually be good for the market. Like I said, ETFs buy OTC, whereas like spot investors, when they actually sell to buy ETFs, they might sell spot. That's kind of a net negative effect in the short run. Long-term wise, I think this will be fine, but it does give institutions more control and maybe even more manipulative control over the price of cryptos. So once again, not that great. There needs to be serious regulations put on institutions, and that's going to take a long while because institutions are probably going to fight against it. Increased regulatory clarity and compliance. Institutional investors operate with strict regulatory frameworks, and their entry has pressured governments and regulators to create clearer rules and safeguards. The push for compliance, including KYC and AML procedures, has lent greater legitimacy to the crypto space. I don't think so, because asking all my friends, they all think crypto is a giant casino, and I can't really blame them for thinking so. Because remember, the ETFs, although great as they sound, they're still based on the price of the underlying asset. And if your underlying asset isn't really being enforced with rules, the ETFs are going to suffer as well. And like I said, I am almost sure that some of these big institutions are shadow playing the underlying market along with exchanges like Binance to manipulate the price to their advantage. Because although the ETF market is very, very regulated, I don't think that for instance, BlackRock may actually have a Binance account that we don't really know about. They might have, a Bybit account and that they're playing leverage with that we don't know about. And it could be just more than one account. They could just have some of their brokers, like several of their brokers, just trading on Bybit without KYC, AML, and without our knowledge. And during the Trump administration, they're really not going to go after that because, Paul Atkins isn't really interested in going after everything. And plus, even if he was, the administration essentially disbanded the crypto regulatory unit, the crypto regulatory enforcement units, basically for the industry. So that's really not going anywhere. So the thing is, retail investors are kind of gaining the initial institutional money rush, which is really cool. But at the same time, you don't really get the protections and you get the institutional dominance. So that's why I'm saying that the effects of the institutions in crypto is the first, there's a burst investment, but then it's just a lot of manipulation and lack of protections because there's lack of enforcement, which is why I'm kind of calling it BS. And although some companies are interested in the blockchain technology and tokenization, they're not actually interested in the crypto themselves. These cryptos themselves outside of DeFi aren't really being used in any way, while the blockchain and technology is actually really, really intriguing. So the thing is, I generally would like institutional involvement in crypto because it does get that regulated money in, which is good, but you kind of have to regulate and enforce the rules on the underlying asset class itself, and that's more of a global market, which is much, much harder to regulate. Because if you don't really regulate and protect consumers on that level, and you don't seriously enforce the KYC AML, you don't really look at what these big institutions could actually be doing on the exchanges that aren't regulated, like Bybit, BitMEX, or whatever, I'm sure a lot of the institutions actually do have accounts on those because it wouldn't really make sense. I can't believe all these institutions are just good people and they're just going to play by the rules because that's not true. So like essentially what you're getting is a lot of the manipulation, but without a lot of the protections because it's a global 24/7 market. It's very, very hard to actually regulate, and you have an administration that really doesn't care too much about enforcement or regulation at this point. So it is kind of a wild, wild west, but it's a wild, wild west with big institutional manipulation and basically big institutional manipulation and buying and control. So it's going to take a while for this to advance and us to like get rid of some of those downfalls. But for the next 3 years or so, I feel like this is going to be the market. A lot of institutional manipulation, maybe even teaming up with places like Binance, and a lot of institutional manipulation in the shadows, with Bybit and like all those other DEXs and CEXs that aren't under U.S. regulation. I bet BlackRock, Fidelity, and all the big brokers, U.S. brokers that aren't supposed to trade on those exchanges actually do have accounts on those exchanges, and they can manipulate the market that way. So expect to see a lot of manipulation in the future. Bitcoin volatility might slightly go down, but as you can see, one Trump tariff announcement can dump it like 30-40%. So I wouldn't exactly bank on the no volatility. I still think in the bear market will go down 50% plus, and I think that'll shatter some of those like thoughts of like, oh, it's institutional now, it can't go down that much. I do think it will, because we've already gone down from like 126 to 95, and that's already way more volatile than the stock market, and I think we can easily go down to the 70s, even the 60s, in maybe even the 50s in the bear market. So we're kind of like getting all the negative of institutional investment for that one small positive of that initial money injection, and then we have to suffer all the negatives because of the lack of enforcement and the really like the impossibility of regulation on a global underlying market of crypto that's kind of built to be sort of anonymous as well. So let me know what you think about that. Do you think that like the institutional involvement is just going to always be like, bad for crypto because it's always going to be regulated? Or do you think that sudden injection of money is actually worth it? So let me know what you think in the comments. Like and subscribe, hit the bell notifications button. Thank you and have a nice day.